Welcome to the Balancing Act podcast with SingerLewak. In our latest episode, join us for an insightful conversation with Alice Pearl from the law offices of Michael K. Lanning and Jessica Nadler, SL Big's partner at SingerLewak. Together, they dive into the topic of estate planning, unraveling the intricacies of maximizing your legacy, minimizing taxes, and maintaining harmony among loved ones. Tune in to explore the essentials of estate plans and trusts, learn about the consequences of not having a plan, and gain insights into estate and trust taxes. Keep listening to learn more.
Hello, welcome to the Balancing Act. I'm Jessica Nadler, a partner with SL Biggs. SL Biggs provides a spectrum of consulting and accounting services outside of traditional A&A tax. Included in our SL Biggs practice is an entire group dedicated to trust and estate matters. We do tax planning, we do administration, we do probate accounting, we do full service trust and estate issues. And as a result of it, I get to work with very wonderful practitioners. So as a favor, I brought in one of my good friends and colleagues, Alice Pearl of law offices of Michael K. Lanning. Alice handles all things estate planning and administration. So you can go to Alice if you're alive and well and need an estate plan, but also if you are a trustee or a loved one administering someone's estate and you need some legal assistance, Alice handles that as well. And I think one thing that makes Alice a particularly strong practitioner is how proactive she is with her planning. She understands the financial impact of estate taxes and has wonderful tax mitigation strategies, but also because of her administration side, she has such an understanding of the emotional aspect of what it's like for your loved ones going through this. And it's not always easy and it's not always sunshine. And Alice, as you're drafting your estate plan, will give you candid feedback of saying, this is how this situation can work out between your kids. How do you want to draft this? And I think that is such a powerful tool to have in a practitioner that her services are absolutely valuable. So without further ado, everyone, Miss Alice Pearl.
Thank you so much, Jessica, for that very kind introduction. It's a pleasure to be here, and it's a pleasure to be on a podcast with SL Biggs, who has such a great reputation and has done so well by the clients that I have worked with that are also SL Big clients. So thank you so much for having me.
Oh, you're very kind. So I think we have to do, a little legal disclosure spiel.
Always important.
Alice, you are a California attorney. Yes. You are not licensed in other states. So your advice is probably California specific, aside from federal estate tax issues. Those are all the same across the board. But trust and estates are California specific or state law specific. So Alice's advice is California. Would it overlap, you think?
Some. So thank you for pointing that out. I am licensed in California. So all of this is 100% guaranteed to be accurate for someone living in California. If you live in another state, there may be some differences. The main area will be, and hopefully we'll speak very briefly about property taxes a little later. That's something I'd like to introduce people to. That will be the main area that's different because that varies greatly across the different states. But any talk, as you said, about estate taxes and most of the information about planning for a trust and a will and estate generally, that will be pretty global across all the states. And if nothing else, we'll give you some suggestions for things to talk with your planner about. So hopefully this will help everybody.
Great. Alice, can you give our listeners a global overview of what is an estate plan and specifically what's a trust? I don't think people always understand what a trust is.
Absolutely. And this is what I see when I'm out in the world. The number one thing that people have misconceptions about is what an estate plan is and how theirs specifically works. So hopefully this will help people. So an estate plan is a very fancy legal term for essentially what happens to your assets, your estate when you die. So think of it as instructions for what happens to your stuff when you pass away. That's in its most basic form an estate plan. Estate plans typically have two main documents. You can either get a will and or get a trust. So a will and a trust are the same in that they're both a document that you create while you're alive with instructions for what happens to your assets when you die. I leave everything to my kids. It's really the most common thing that you see in both. They vary in complexity. They vary in length. They vary in flexibility. Trusts typically are much more flexible than wills are. But the main difference between a trust and a will is that a trust avoids the probate process and a will does not.
And what is probate for our listeners?
So probate is actually, the term comes from a very old Latin term, probar, meaning to prove.
Oh, look at you throwing in some Latin. Very impressed.
Yes, thank you. It's my only Latin word, so I like to bust it out to make myself seem very, very highbrow. But it's from the Latin meaning to prove. So it's literally the process of your executor or your administrator, which are the people that manage your estate, going to court and telling the judge, this person died, and proving it. Here are their family members, heirs, and beneficiaries, and proving it. Here's what they owned, and proving it. So it's a many different stage process of going to court. And at the end, the judge issues an order saying, okay, you're the executor, the manager. Here's what the person who passed away owned. Here's who's receiving their property.
So I just want to interrupt you for a moment to stress this, because I think it's such an important thing for our listeners to understand.
Mm-hmm.
If you have a trust, it can be administered without court guidance.
Correct.
Just amongst the parties.
Correct.
If you have to go to probate because you only have a will or no estate plan, you have to go in for court supervision.
Exactly.
And what is the time frame roughly for probate these days?
So I practice in Los Angeles County. In Los Angeles County, a probate on average is 18 months to 2 years. And the more complicated estates, or if there's any infighting, that takes way longer. So if you want your money to be tied up in the Los Angeles court system for 2+ years, then, go to probate.
And this doesn't mean just money. This also means houses.
Exactly.
And businesses. Anything that was not titled in a trust will end up in probate.
And you really need court approval for everything. So let's say the house is too burdensome, your heirs can't afford to keep it. They have to wait till the court gives them permission to, dispose of that asset till its value, until they reach a certain stage in the probate. So it's very burdensome and it's very expensive.
How much does probate cost?
So probate fees in California are set by statute, which is a fancy term for law. So if you're at home, Google California statutory probate fees, and you'll see that they're just set by statute, and it's based on the gross value of your assets. So if you have a house, the courts don't care if you have a mortgage. The cost of the probate is the same. So the court will have an appraiser value the house. And let's say it's $1 million house.
In LA, that seems pretty fair.
Exactly. That's cheap for Los Angeles County. Let's say you have $1 million house. The attorney statutory fees on that, meaning no flexibility set by statute, are $23,000. The executor statutory fees are $23,000, plus court costs, plus appraiser fees. You're looking at probably about $50,000 worth of fees that your heirs are going to have to come up with to probate this $1 million.
Just for one asset.
Exactly.
So I think Alice's example is actually great to help people visualize. $1 million asset in California will cost you $50,000 in probate fees.
Mm-hmm.
Oh, and that's just one asset. And the percent changes based off of the ongoing assets. It's statutory schedule. So it can keep going up. It doesn't flat fee out.
Exactly. And it includes everything that was in just your name when you died. So, bank accounts, stock accounts. It can be extremely expensive, extremely time consuming. It's virtually impossible to navigate the probate system without an attorney. People can do it, but it takes forever. It's very difficult. There's a lot of complex rules. So almost certainly they're going to be paying that and taking forever to get your estate cleared through the probate court. Much better to have it managed by a trustee that you select outside of the court system.
So I'm just going to reiterate this for our listeners because, again, I think it's such an important concept. Everything needs to be in a trust. Otherwise, you will go to probate, and probate is not only very long to get a court hearing, it's also very expensive and gets very expensive very fast. And Alice, you are worth every single penny under the sun, I think. However, is it fair to say that if you were handling an estate plan that just had some bank accounts, a house, and maybe a securities account, average assets for most people, wonderful assets to have, will the estate plan cost in excess of $50,000?
No, absolutely not. It'll be significantly less.
Okay, so there really is no downfall for trusts. There is a significant cost to not having a trust in California.
Exactly. And, really meet with your planner and tailor it to your needs. You might have a specialty asset that they recommend gets a beneficiary instead of a trust. So this is really, a global general rule, but it's still, the point stands. get a trust to avoid the time and expense of probate.
So a common conversation I have with clients about their concern about a trust is that they lose control. I think it sometimes gets confused with a trust fund where, someone's nice enough to give you a bunch of money, but there's restrictions. Is a trust the same as a trust fund? What's the control aspect?
No, it's not. They're completely different things, not related at all. And that's actually a common misconception, that a trust will cause you to lose control over your assets. There is, for a person creating a revocable trust while they're alive, no difference at all post-trust and pre-trust in terms of control, taxes, ability to file, no separate tax return. The only difference is when you look at your monthly bank statement, when you look at the deed to your house, instead of it saying, Jane Smith, owner, it'll say the Jane Smith Trust, owner. That's the only difference. Otherwise, there's no loss of control, no tax change, no nothing.
So it's a form over substance issue in a way.
Absolutely.
So I can still sell my asset. I can give it away. I can do whatever I want with my asset. Nothing has changed if I put it in a trust other than how it's titled.
Absolutely. It's exactly the same. And you can change or get rid of your trust anytime. There is zero loss of control.
Great. So I think this was a great introduction to trusts in general and the importance of why everyone needs a trust. Doesn't matter how wealthy you are, you need a trust. But trusts can get complicated, and some people require more advanced planning depending on their asset values. And that has the primary reason is because of the estate tax. And for those of you who are not familiar with the estate tax is a one-time tax. It's based off of your assets when you pass away. It's kind of everything freezes on that date. You get the fair market value of those assets, and whatever your estate is worth potentially is taxable. Now, the taxable amount varies person to person because everyone has what we call a lifetime exclusion or exemption.
Mm-hmm.
This year, it's around $12 million, which sounds like a lot. It is. It's wonderful. But that number changes every single year. And a really big impact that Alice can talk about, or at least wage a bet on with me, is that number is going to go down in January 2026. 2026?
In January 1st, 2026. Yeah.
So the reason it was increased from around 5 million to 10 million several years ago, but that law is set to sunset as of January 1st, 2026. And no one yet knows what that new number is going to be.
Correct.
Alice, what's your bet?
So just to expand a little bit on what Jessica said, when we talked earlier about getting a trust, that's something that applies to everyone. What we're talking about now, this quote, advanced planning or estate tax planning, only will apply to people that have estates that are of a certain value.
Oh my God, thank you. I forgot, I skipped the concept. Thank you so much for picking that up. So the reason I was talking about the annual lifetime exclusion the lifetime exclusion is because that is your threshold for if you are going to pay taxes on your estate or not. So let's use this year as an example and rounding to 12 million. It's not exactly 12 million.
Mm-hmm.
If you have $11 million in assets, there's no estate tax.
Exactly.
If you have $12 million, there's no estate tax. If you have $13 million, you have a taxable estate, and the tax is the 13 million minus the 12. So whatever your total estate is less that annual number. Again, that annual number changes, and the tax rate is 40%. Oh, lifetime number. Sorry, annual lifetime. That number is 40%
of the excess. Yes, that's correct.
Of the excess. So that gets expensive very, very fast. Imagine you leave your loved ones a legacy of $100 million. And anything over that $12 million, so on my head, $88 million,
yes,
is taxable at 40%. That's a very large tax to have to pay the U.S. government. Again, that is a one-time tax.
A one-time tax, but what a lot of people don't understand is that tax, that estate tax, which is a tax on anything over the exempt amount, has to be paid within 9 months of someone's date of death, unless they're on some kind of extension that's been properly filed. So, a lot of people are grieving, and a lot of people have what are called illiquid assets, a house, stock, family business, things that are not cash, readily available cash. And so what happens is you die owning, a couple pieces of property, a business. All of a sudden you have a $20 million estate. You're going to pay estate taxes on that $8 million difference between the estate and the exemption amount. And that has to be paid in cash for the 9 months of when you die. So what happens is it's like a fire sale. Your children start selling off your assets. They don't get the best possible price. And in addition to now being hit with the estate taxes, and this is much more your area than mine, Jessica, they're going to start to get hit with, the income tax, the capital gains taxes on the sale of these assets.
Yes. I just want to chime in for 1 second because we are talking about taxes. And I think a very common misconception is inheritance is tax-free.
Yes.
So you have the 40% estate tax that we just talked about. But also, regardless of the size of your estate, unfortunately, the nature of things is sometimes your estate's not going to get administered overnight. It does take time.
Yes.
And if you're fortunate enough to leave your loved ones income generating assets, someone has to pay income taxes on trust assets every single year when they are in the trust. There is an annual trust return required if there's a filing requirement, which is anything over $600.
Mm-hmm.
So that's dividends, stock sales, business sales, capital gains, anything that you would normally have to report on an income tax return, trusts have to report too. There's a question of, does the trust pay the taxes or does the beneficiary pay the taxes? There's pros and cons to both that when your professional can discuss with you. I'm happy to discuss this issue anytime because I understand that a lot of people are a little surprised when they get a K-1 at the end of the year and have to pay taxes on their inheritance. So I do want to stress, because I think it is a very common issue in administration, inheritance is not necessarily tax-free.
Yeah, so Jessica just did a great sort of introduction, and this is really her area of expertise, income tax and tax on estate. So she can definitely expand on that further. But yes, inheritance is not necessarily tax-free. It depends on what's being inherited, the value of what's being inherited, and the total value of your estate. So definitely don't let your children know that everything they inherit is tax-free, because that's not necessarily true.
So Alice, we talked about the issue for larger estates. Again, the current lifetime exclusion is around $12 million.
Yes.
It might go down to 5. It might be 7. Nobody seems to know the answer. You got to have a crystal ball. So in the meantime, do you mind sharing a few tips of your trade on ways that somebody with potentially a taxable estate can mitigate that estate tax? Because there are ways to lower that number in advance, but you got to do it in advance.
Absolutely. Once you pass away, there's nothing anyone can do to reduce your estate tax. Absolutely nothing at all. It is what it is. So as Jessica said, the estate tax is going to apply to any estates that are over that exemption. Currently, that exemption is slightly over 12 million. That number is going to change in 2026 to 5 million, 7 million, hard to say. But if you plan to live past January 1st, 2026, and you have an estate that's over, I'd say 5 million, then this is applicable to you, and you're someone who should consult a planner about planning for your estate. So yes, there are ways to mitigate the estate tax while you're alive. As I said, your estate is what you own when you die. So all estate tax mitigation centers around you not owning things when you pass away. And so you can gift it, you can sell it, you can do various things with it, transfer it to your children in ways that maximizes your exemption.
Yes, and just as a friendly reminder, if you gift something, there is also a filing requirement for anything over the annual exclusion. This year it's $16,000. It just depends year to year. You do have to file them. If you forgot 1 year, not the end of the world. There's no penalty for filing a late gift tax return, a Form 709, if there were no taxes due. So there are some people, I've done 5-6 years of gift tax returns. There's no penalty. They do eventually need to get filed. If you don't file them, most likely the loved one that is administering your estate will end up having to file them. So do file them. But I think one thing we need to stress is if you gift, you don't get the double dip. You don't get it's a double-edged sword. It does reduce your lifetime exemption. So if you gift, if you give away $12 million of assets, when you pass away, that means anything is taxable because you've used up your lifetime exemption.
Exactly. And again, this is a very sort of high-end concept, if you will, that's very complex. So we're really trying to give you a very brief introduction. Definitely ask, the planner you're working with to go over this with you again if you have a potentially taxable estate. But as Jessica is saying, if you are an estate that's going to owe an estate tax, you can gift to your children. Depending on how much you gift, you can have a 709, a gift tax return filing requirement. People like Jessica can help you with that. We do them sometimes for people we plan with, but Jessica can certainly help you with that.
And also, if you want to be a loving parent, grandchild, there's nothing wrong with that. There are a few ways to be able to give a large amount without it affecting your lifetime exemption.
Yes.
Alice, what are some common things somebody can do in like 10, 20 seconds?
Yeah, so my firm does work with a lot of what they call these high net worth, ultra high net worth people, aka people that are going to owe estate tax. And there's a lot of great tools to take advantage of annual exclusions and other gift tax and estate tax rules to maximize your exemption. So you can set up an insurance trust. You can set up a 529 plan for your children.
You can pay somebody's education expense
directly to the school, yes.
If you don't give them the cash, let me stress this, you cannot give the person the cash and then have them pay their tuition. It's got to go directly to the school. This is a great technique for parents and grandparents, well, more grandparents, because parents can pay their kids' tuition. For grandparents to pay their grandchildren's tuition, but you've got to pay it to the institution directly.
Absolutely. So there's many ways to gift that will not eat up that pot, that $12 million in the future, potentially $5 million pot.
So speaking of gifts, I'm going to cut you off because I think there's been a big change in California in the last couple of years that we need to talk about when it comes to gifts. Gifting your house to your children.
Don't do it without proper planning. I can't stress this enough.
So for our listeners' reference, there was a significant law change a few years ago about property. Before the law changed, you could leave your kids your real property and there was no property tax reassessment. So if you bought your house in the 70s and the 80s and you're paying a low property tax rate, there was no reassessment to that new $2 million value that you got now in Los Angeles. However, since that law has changed, that no longer exists. So
absolutely.
Alice, are there ways now to transfer property to your children without triggering a reassessment?
Yes. So for those of you who are just wholly unfamiliar with property tax, it's very basic introduction to help you understand what Jessica and I are saying. When you buy property in California, you always pay property taxes with a slight inflation adjustment based on that initial purchase price. Okay. If there's ever a change in ownership, meaning a new owner, the property gets reassessed. So a lot of people have had their home, 40, 50 years. They're paying property taxes based on a $300,000 purchase price. Even though if they were going to sell their property tomorrow, they could sell it for $2 million. And so what you don't want is you don't want your property to get reassessed, aka you don't want the county assessor to look and say, due to something that you did, we think there's a change in ownership, aka we're now going to base your property taxes on this $2 million value.
So you need to contact an attorney before you change any property title. I think we should summarize that as the absolute steadfast rule of do not change title to a property without consulting your attorney. It's wonderful to give things to your children and loved ones, and there are potentially ways to do it, but it's much more complicated than it was a few years ago. So please, please, please contact an attorney. This is not an easy issue. I regularly call Alice on this issue. You've got to know the specifics.
Absolutely. Do not put your child on the title to your house. I had a very sad case where I believe it was a client's refinance company actually told them to just add their child. They did, and long story short, the property taxes got reassessed. The parent could no longer afford to keep the property. She had to sell her house that she lived in for 50 years and moved because she got some bad advice from someone who didn't necessarily understand all the intricacies. So work with a proper planner if you want to give to your children. Don't just be putting your children on your house title. It's a big mistake.
So I think Alice has given us some wonderful insights into proactive estate planning. Let's reiterate. First, you got to have a trust.
Yes.
If you are worried you have a taxable estate, this year $12 million, there are ways to mitigate with advanced planning, but you got to plan in advance.
Yes.
There are wonderful ways to transfer assets to children and loved ones that do not impact your estate taxes, but it requires proper planning.
100%.
So if we can take up a couple more minutes of your time and experience, you also do administration.
Yes.
What are some tips you can give trustees to help make administrations run smoothly? Because I think you and I can attest to the fact of no good deed goes unpunished when you're a trustee. It's a hard job, and there's a lot of emotions involved. People are mourning the loss of a loved one. And unfortunately, sometimes things can escalate. But there are things a trustee can do to keep everyone at peace and have this be a simple administration and loved ones still be happy.
100%. So a trustee is the manager of a trust. An executor is for a will, a trustee is for a trust. So let's say you're the trustee, your mother has passed away, and you're trying to administer this estate for yourself and your siblings. A couple things. For the person who passed away, who made the plan, the mother, my advice to them would be make sure you have a detailed plan, make sure you have a flexible plan. And the number one thing is make sure you meet with your children before you pass away and say, here's what my documents say, here's what my plan is, I'm preparing you.
And the more detailed, the more guidance, the better. Hopefully everyone will get along, but if not, at least you've also left instructions to the court of what your true wishes are.
100%. And then once someone's passed away, for the trustee managing, I have the following advice. Number one, be very transparent with the siblings. And number two, make sure that you are just documenting everything. Being a trustee is a lot of work. You are entitled to a fee for your services unless there's a in my opinion, badly drafted trust that says no fee for you. But most of the time you'll be entitled to a fee. But make sure you document everything. If you pay your parents' property taxes, that gets paid out of your parents' bank account, the trust bank account, document it. Your siblings, the beneficiaries, are going to be entitled to an accounting. And Jessica, I think you should speak a little bit on accounting.
So every beneficiary can ask for an accounting. There's no way around it. If they ask for it, you have to give it to them. And a trust accounting is very different than ordinary accounting. It's not GAAP. It's not your standard financials. It's prescribed by the probate code, and it's very, very specific in substance and format. And it essentially shows where every penny of trust money went. So I cannot stress enough the importance of keeping accurate records. Some tips I have are keep an Excel file or a QuickBooks file. A QuickBooks file is not terribly expensive, and the trust can pay for it. It's okay. I do want to stress trustees have a right to spend trust money on proper expenses. So your attorneys, your accountants, you're not paying for this stuff out of pocket. It's management. It's a business expense almost. It's a trust expense. It's okay. And the other one is, so keep accurate records, and then please, please, please do not pay with cash. It is so hard to remember what you paid for cash with. Do not pay with cash, and do not pay with credit card, actually, because a trust should not be using a credit card. And otherwise, it's actually pretty hard to remember what you paid on your monthly statement for. So I would recommend using checks as much as possible.
Agreed. So just to sum for a trustee, and then to add a couple new ones just very briefly. Number one, be very transparent with your siblings so that people can't have the time to get into their head that you're doing something wrong, that you're stealing, that you're not obeying the trust. Be very transparent. Number two, records. The easiest way to show somebody that you didn't take an illegal penny from the estate is to say, look, here's a list of everything that went in and out. Here's a copy of the checks. And, in cases, we always recommend this, but I understand it's not always feasible for people, but we always recommend, here's an accounting prepared by the accountant. A firm like Jessica's does this. That's, very above board and unassailable. Number three, start early. I understand that people are grieving and that sometimes can be difficult, but as a trustee, you're required to comply with certain deadlines, certain notice periods. If you wait too long, you can lose certain property tax exemptions. So please start as soon as you can with the administration. And number four, really hire competent help. The estate pays for it. The trustee does not pay for it personally. Get an attorney, get an accountant. Not only will it make it more efficient and make sure that the trustee does not have liability for something they're doing wrong that they didn't even know they were doing wrong, but it also saves family relationships because your siblings, instead of getting mad at you, the trustee can get mad at the attorney. And so it really helps preserve.
Nothing wrong with blaming the attorney or the accountant. We're used to it.
That's what we're here for.
Save your relationships, blame us. I think based off of today's podcast, I think the old adage of the one thing in life you can't escape is death and taxes is very true. And that seems to be the combination of me and Alice.
Exactly.
Alice, real quick, are there any other documents in an estate plan that you recommend?
Yes. Before we go, I do recommend that you get powers of attorney. So a will and a trust, your quote, testamentary documents control when you pass away. Powers of attorney, both medical and financial, control while you're alive but incapacitated. with the longevity that people now have in their life, the number of years people are living, most people or a lot of people will at some point in their life become incapacitated. So make sure you get powers of attorney in place so that there's no fighting over what to be done with your finances or with your medical decisions while you're incapacitated.
Yes, because you can't sign that after you're incapacitated. And if it's not prepared in advance, you're going to court.
Absolutely. And then my second thing is make sure you fund your trust. If you go through all the effort of setting it up, you really want to make sure that you put your assets into it so that those assets avoid probate. And number three, make sure you go to a competent planner who has experience.
Alice, thank you so much today for your time and your willingness to share your expertise with our audience.
Absolutely.
You're a wealth of knowledge and always such a helpful resource. I can't thank you enough, and I can't encourage people enough to give you a call if they have questions. Alice, do me a favor, remind our listeners of how they can get in touch with you.
Yes. Once again, everyone, my name is Alice Pearl. I'm an attorney at the law offices of Michael K. Lanning. We're located in Brentwood, which is a neighborhood in Los Angeles, California. So just Google Alice Pearl, law offices of Michael K. Lanning, Los Angeles. I should pop up. But let me give you the firm phone number just in case. Our firm phone number is 310-820-1600. Again, 310-820-1600. Call, speak with one of the legal assistants at our firm, and they'll put you in touch with me. And Jessica, as always, it's a pleasure. I look forward to continuing to work with you and SL Biggs in the future. And thank you very much.
You're too kind, Alice. And if you need Alice's contact information and it's hard to find on Google, never know what happens, you can absolutely reach out to me as well. I will happily give you her contact information. Or if you have any questions about the information we discussed today, I'm happy to give feedback, share opinions, whatever you need. I'm always happy to talk about trust and estate issues. It's such an important concept. Advanced planning is the best way to leave your loved ones a legacy and a roadmap. You do not want people to fight. So please, please, please draft an estate plan. It's the only way to ensure that your wishes will be followed after you pass. So Alice, thank you again for your time and your knowledge. And to our listeners, thank you so much for listening to another episode of The Balancing Act.
Thank you for tuning into this episode of The Balancing Act. We're here to help with proactive planning to mitigate the burden of your taxes on your estate and provide administrative services and planning. To learn more, visit SingerLewak.com. If you enjoyed this podcast, please subscribe so you don't miss an episode. Together, we can make a difference in the lives of those who need it most.